our June Inside Grants webinar. So, for those of you who have not met me, I'm Aaron Taylor. Uh, I've been a part of Inside Grants for most of this year and a little bit of last year. I'm one of the newer senior consultants here at Team DWC. I know from looking at the list of participants, we've got some familiar faces and we've also got some new ones. So, I'm just really excited to have everyone here today, and I hope you all learn a lot. I am going to ask a question in a little bit to get some participation and see if you all can potentially guess the 10 things we're going to talk about today. Uh, so let's go ahead and get started. Uh, if you all don't know about Team DWC, we do host Inside Grants. We are a team of federal grant experts. At this point, former federal grant experts. We are fortunate to have a lot of individuals join after the HHS reduction in force actions last year, including myself. And we are all really excited to engage and share federal grant knowledge in a new way and with an insider perspective. We like to use Inside Grants to share this information in a free webinar format, tackling topics that are often very challenging in the grantee community and topics potentially that people, particularly federal agencies, don't like to spend a whole lot of time talking about or lack the resources and knowledge to really engage it fully. So today is going to be kind of an all-encompassing day. And I think we'll have a lot of fun talking about this. And my goal is to do a lot of storytelling. And hopefully the stories or the topics resonate with you and gives an opportunity for you to go back with your teams and have some creative and interesting conversations. For those of you who don't know my background, I'm Aaron Taylor. I was part of the HHS reduction in force last year. I had the opportunity to work in federal government for nearly 14 years across 5 agencies, and I will get to share a lot of those stories and experiences with you all today. I spent my first 10 years at HUD doing grants management, mainly capacity building focused, and I was also an audit liaison officer working on its Office of Inspector General audit resolution for HUD and CPD's big programs, including CDBG disaster recovery, home, affordable housing, and our environmental review division. I then went to SBA. From there, I also was with USDA, NIH, and then I spent my last 3 years working with the aging and disability focused formula programs at ACL. So today in our 10 common federal grant mistakes presentation, my goal is to hit every single subpart of 2 CFR 200. In our most recent presentations, we spent a lot of time in D through F because that is the key to post-award management, and you spend the majority of your time in post-award activities. Today, I really set it out to be my goal to hit all of the subparts, particularly going back to some of the definitions and the basis for uniform guidance scoping. That's in subpart A. As a reminder, we always talk about uniform guidance and accessing the regulations. We recommend that you use the ECFR website because this is put out by the federal government and it's the official record and the most updated version of all the regulations, including 2 CFR 200 or the uniform guidance. We also provide a link when we post our presentations to the final rule because the final rule goes over recent updates to 2 CFR 200. During last month's presentation, we went over how federal governments approach monitoring, right? And I've had the opportunity to be a monitor in 5 different federal agencies, and particularly at ACL, to really write and scope how fiscal and administrative monitoring was being done, both for aging and disability programs. I spent a lot of time particularly writing resources and doing monitoring in independent living. When I gave this presentation, I talked about 5 focus areas, and that was policies, processes, systems, controls, and impacts. We walked through the approach to policies, to process systems, controls, and impacts. And those are going to feed into our discussion today of 10 common mistakes. Uh, each of the mistake we will talk about will identify defects or non-compliance issues associated with one or more of these focus areas. Before we start, I said I would reach out with a question. For those of you who want to participate, if you can enter something into a chat, what do you think one of the common mistakes will be today? This does not have to be a self-reflection piece. This can just be a pure guess, because I'm always intrigued to hear from grantees about this. One of the other things I talked about in our monitoring presentation last week is that when I approach monitoring with grantees, I always go with a three-part mindset. Number one, compliance, right? Because we talk about that. But the other two pieces are probably bigger, which is learning and technical assistance, right? This is my learning phase. All right. Budget and narrative that do not match, lack of documentation, backup docs, documentation, right? That's going to be a really good one. And lack of process. I love that. And I think we're going to start with that one first. So the number one most common mistake and resulting finding that I've put out, especially in recent years and post-COVID, is outdated or inaccurate policies and procedures. Uh, I'm not sure if you all would be surprised. I was surprised initially when I was reviewing nonprofits, particularly in the last couple of years, and I would see that they haven't updated their financial management policies and procedures in a decade. And a decade's particularly important because when we look back to when the uniform guidance originally came online, it was about a decade ago. So I think that was the last time some nonprofits approached their policies and procedures because they were changing from the circulars to the uniform guidance, either at 2 CFR 200 or 45 CFR 75. But there's a lot of other reasons why you want to stay on top of your policies and procedures, either programmatic or financial. One is because of COVID totally changed how many of us did work at an organizational level. We embraced remote work or virtual work in the first time in a big way, and that's potentially become a significant part of our operations as we've moved forward. And this totally changes core policies and procedures, checks and balances, systems, and internal controls that are part of your everyday life. And this has to be integrated into your policies, right? They should be up to date and align with how you're doing the work now. Um, it's very likely that you've had leadership or staffing changes that have gone into play, or maybe you've done a reorg and how you align positions and position titles, and those need to be reflected into your policies. Your organizational chart, your current job descriptions need to be tied back to your policies and procedures to show that the work you're actually doing in practice right now aligns with your codified policies. And one of the reasons I say over and over again with codified policies, because there are several key uniform guidance regulations that require you to be doing work, and that set compliance standards based on whether you're working in line with your current policies and procedures, right? And specifically, I would go to 302, which are the financial management regulations. They say, specifically that you are implementing processes, reviewing cost, assessing allowability in line with your own policies and procedures. If you do not have updated policies and procedures in place, or the processes you're implementing are inconsistent with your current policies, then you're going to get a finding straight up. It might result in unallowable cost. It might not. Likely, it will increase oversight from your funder, either through a corrective action plan as a result of the monitoring finding, or potentially with increased higher risk management terms and conditions on your award. Also, it's going to impact the internal controls and how you frame checks and balances within your organization, because increases the likelihood of inconsistencies. Right. So someone mentioned about budget and narrative not matching, and I think that aligns right into this finding. And that is you did not read the award terms and conditions. One of those pieces that could come up is that the way you formed the budget and narrative don't align to all of those unique program requirements that were in the notice of funding. Particularly, I saw this a lot with formula grantees because they're used to getting funding on an annual basis and have been implementing the program year in, year out, but they don't take the time always to read the new grant awards each year and to see if there were changes in the specific terms and conditions or updates in the general terms and conditions in line with the agency level, like Health and Human Services. Um, an example of this recently might have been the phase change to 2 CFR 200 or things around, BABA and Buy America. The other piece that could stick out here is understanding how to blend statutory and regulatory compliance markers. For example, there could be a set standard in the Uniform Guidance on Program Income or match, but then there's statutory requirements within the appropriation or the authorizing act that change how you would normally approach match or cost share program income. They set requirements that have a higher burden or extend conditions. And your SOPs, your processes, your internal controls, they need to be reactive to that and open to modification to align with the statutory standard because the statutory standard's always going to override the regulatory standard. If you fail to read the award terms and conditions and you fail to meet key terms and conditions or are ignorant about the expectations, these could have real compliance risk. Particularly, you could miss out on reporting requirements. You could be inaccurately tracking outcomes or outputs or not tracking financial matters in the correct manner. You could misuse funds and have unallowable costs. And I think you'll see as we go forward, the risk of unallowable cost clearly increases with these mistakes. And if anything we see in the current administration, it is a desire to identify fraud, waste, and abuse and to pursue collections when there is unallowable use of federal funds. When I work with nonprofits in particularly, or grantees that have multiple cost streams where their staff are direct charging time to multiple revenue streams, even if this could be two different grant numbers under the same program, right? Because you have concurrent awards, then there's often timesheet inconsistencies, right? Probably the most common basis or reason for this mistake is because staff don't understand the expectations. Either the expectations haven't been clearly written out in policy and process, they haven't received training, or the supervisors that are reviewing the timesheets don't hold them accountable. Speaking of supervisors, when I look at timesheets or do a monitoring review in the federal space, I will look at consistency in review and consistency in approval. Oftentimes, I will see a timesheet period or a pay period and see that some forms are signed by the employee and management. Some are signed by the employee. Some are signed by the manager, but not the employee, or some are not signed at all. And all of these are moving forward to payroll that's issued because no one wants to miss out on payroll. But these are huge internal control concerns because the manager reviewing the timesheets is the one substantiating actual time worked in line with 2 CFR 200-430, and they're substantiating the cost allocation, particularly if you're splitting an individual's time across multiple revenue streams, because this means that they're reviewing for eligible use of funds and actual work performed on those awards. In addition to timesheets, we talked about them being incomplete because of time lack of signature, but this also could be incomplete because the hours don't add up, or they missed a day, or the cost allocation method or programs are labeled wrong and they incorrectly distributed time into a program that they're not actually working on, right? Even basic mistakes at the staff level, if they're not caught through the internal control of the management review before payroll's issued, what's the likelihood you're going to go back and correct this? And then you have a potential liability sitting out there of unallowable cost, right? Timesheets really comes down to consistency and then affirmation of actual work done and management review to confirm that funds are being used allowably and that you're a good steward. Over and over again, I would see issues with timesheets. And because many of these awards that I worked on were payroll heavy, that meant a huge percentage of the award was at liability because there was not an accurate representation of actual time work and distribution of staff effort. And then that last piece speaks to having updated policies. This helps with setting a universal standard across the organization and helps to offset, training expectations because there's a centralized resource source to help onboard employees to ensure that they're starting on the right foot and meeting timesheet expectations from the beginning. So coming back again to that comment about budget and narrative not matching, an issue that we'd see, particularly in discretionary programs when I was a federal employee, is overpromising on grant applications. And this could be overpromising return on investment, so being able to do more with less. It could also be a misunderstanding of the expectations, the deliverables, the outputs and outcomes for a program. Maybe they didn't understand the definition or context of a specific output or outcome within the program they were applying, even though they were used to recording that output or outcome in other programs. Everything might have been good on the front end, but once the project got implemented and you finally got the grant agreement and the funding, that staff you were counting on or that partner you were counting on disappeared. And now you don't have the capacity to do that work. So your ability to deliver on the outputs and outcomes that were projected is now diminished. What do you do? Or maybe this was a new program for you and it was a potential stretch and you overstated your abilities. You embellished a little bit. Pretty common, right, on discretionary applications. And the last piece is the reminder to really read through a notice of funding when you're applying for a program and make sure you review the section on minimum criteria to ensure that you meet all the minimum criteria to apply for a program. In my experience, if there's an issue with meeting minimum requirements, you do get awarded and it's found out after the fact, the fault is going to be on the applicant. And this specifically happened on a capacity building program I was working on at HUD. An award was made to an entity that did not meet minimum criteria. When they submitted the application in grants.gov, they were confirming that they met all the criteria and certifying their position. It was found out 3 months afterwards that they weren't a nonprofit organization, which was a key eligibility and award criteria. Therefore, we had to terminate the award and the entity had to repay all the funding they had drawn down to that point. So I cannot emphasize enough, if you are applying to a new program, to double check all of the minimum criteria or eligibility criteria. Federal government should have checks and balances and internal controls in place to ensure that they don't award ineligible entities. But if they do, realize that when you submit the application, you're certifying that you've met and reviewed all the eligibility criteria. So if there's a question Afterwards, the onus and fault is on you. And then documentation, documentation, documentation. This was the most common comment or response that we received in the chat. And this is correct, right? Um, Lack of supporting documentation is the most common reason for monitoring findings that result in unallowable cost because there's not documentation to support an eligible use or an allowable use of federal funds. In my recent experience as a federal employee, this would commonly come up either when I was doing a monitoring or follow up on a financial report, and I would ask, straight up for supporting documentation. I get confirmation that an email was received, and then a week would go by or 2 weeks would go by, and there would be no response. And this is pretty indicative of an organization that does not have strong record keeping standards and does not have a clear process in place to justify its use of funds, which opens up weaknesses and liabilities and risk associated with internal controls, policy and process, systems, because when you submit for draw reimbursement on a federal award, it should be really clear, abundantly clear, why you're submitting for that. You are submitting for X dollars of salary and fringe, Y dollars in rent or direct services, and Z dollars in indirect cost. All of this should be laid out very clear in your cost allocation plan and totally locked down and in place before you submit for reimbursement. We'd also have situations where we see everything allocated correctly on a general ledger. You see recording of the expenses, proper allocation following a cost allocation plan, actual evidence of payment made to a vendor or to an individual. But when you go back to the policies and procedures, it says, hey, we'll complete a cover sheet every time we're going to issue a payment. And what we find out is that that cover sheet was not done, and there was no actual internal review to ensure that the program specific requirements or minimum uniform guidance standards were assessed to ensure that the payment made was actually allowable, eligible under that program, right? So even though things may look good on the surface, if you're not doing your underlying policies and procedures, there's particularly inconsistencies within key approval processes and internal controls that can result in a finding because you're not providing evidence that you're actually doing the processes you say you would do. And then one I was surprised about, but commonly came up with formula awards, was a tendency to track a program in the accounting system as opposed to tracking a grant award. That way, this meant that when there was concurrent awards that have overlapping performance periods, it wasn't always clear how an entity would prepare their standard form 425 or federal financial report to appropriately distribute expenses to one grant number or the other. It also created an issue when there was fiscal year changeover and carryover funds, one in projecting budgets for the next year, but also to the point I made originally, which was actually reconciling expenses to a specific award. Sometimes this can be further complicated if you're an entity receives a pass-through award because the pass-through entity is not always specific in what award or grant number they're using to deliver the funds to you and or to actually reimburse the expenses when you submit submit your reimbursement form, right? I'm going to take a quick pause before jumping on to six and, share some stories about specific mistakes that I saw in process. And also just to remind you of the importance of understanding the program and the statutes associated with that program relative to the uniform guidance. And a lot of times when I'm working with grantees, I talk about rule or requirement stacking. So everyone knows that uniform guidance, federal rules, every press release and article confirm that you can't use federal funds to buy alcohol. But I actually worked on a program at SBA post-COVID that helped entities that were entertainment venues and had to shut down during COVID to secure operating dollars to make up for the losses that they had. They delivered these as direct grant awards under the uniform guidance. And the statute created allowability for reimbursing alcohol expenses. And this would have been for the purchase of alcohol as inventory in the bars that were at these entertainment venues. An extremely narrow and unique statutory interpretation that overrode the uniform guidance, but put us into a position of the only federal grant program that I've ever known of that actually reimbursed alcohol as an eligible expense. Another instance of this was when I was working on a CARES program at ACL, and specifically it allowed entities for the first time to purchase stuff, and particularly to purchase stuff for individuals with disabilities that missed out on the opportunity to pursue. And I'm going to just do a quick mute all. So particularly, I was working on a COVID program that was serving individuals with disabilities. And in order to achieve individual goals, because they were missing out on the in-person interaction, then it allowed for the opportunity to purchase devices that could replace opportunities for social engagement and continued interaction with peers. In this instance, the organization had a really good internal control and checks and balances and programmatic review process in place. They purchased an Xbox for an individual to allow continued social engagement. And after review and coordination with the program office, we said, yeah, this is eligible. And again, like the alcohol example, I could never think of instances in other federal programs where we're approving purchase of an Xbox or a video game system. And I make this point because of the importance of understanding stacking, right? And all the different requirements and the levels of requirements that are associated with your program, because they are going to create at times very unique standards for a specific set of funds that won't be applicable to any other revenue stream you have. And you need to be intentional about making pivots within your organization to ensure that you deviate from standard policy and procedure in order to align with these flexes or pivots that you have to do in a program specific situation. I also wanted to come back to that point about federal agencies being fallible. And I gave the example of an entity that was awarded at HUD and then later terminated because it was found out they were not eligible. And this was done by doing a routine nonprofit search on the IRS website. It should have been installed as an internal control on the front end during the application review process, but it wasn't done and it was found out later. That scenario of finding out something later, either getting a disclosure because a new process is implemented to protect internal controls, or because you potentially get a citizen complaint or information from an outside source that, if affirmed, can result in adverse action to an organization. And I'll say this happened when I was working at ACL, because for the first time we implemented a grant management process to start affirming with available public resources the Section 725 standards for SILs. And this resulted us doing some new annual checks and balances that questioned the alignment or compliance with specific standards and assurances, which resulted in us opening monitoring events and potentially, taking some pretty severe adverse actions against SILs. And this had not been done before, but it was an update because of, bringing in stronger internal controls at an agency level. We're going to go ahead and shift back to our countdown and do 6 through 10. I'm going to make plenty of time available at the end of the presentation if anybody has any questions. This is pretty normal practice for us with inside grants. Uh, if you all have, anything you want to drop into the chat where you need clarification or want to go ahead and put a question in, I'll either try to pick it up here as we're going along or come back to it at the end. So one of my favorite things as a federal grant reviewer was utilizing the Federal Audit Clearinghouse. So for those entities that expend more, and the new standard is $1 million in federal funds annually within their own own fiscal year, right? Their organization's own fiscal year, are required to get a single audit in line with 2 CFR 200 subpart F. I was able to open a monitoring or pursue further compliance review on entities that had clean audits on a regular basis. One of the primary reasons this would happen is because of SF 425 or Federal Financial Report Review that resulted in inconsistencies with the CFA or the Schedule for Expenditure of Federal Awards. So in every single audit report that you produce, you have to provide a CFA, which runs down through all of your federal sources and provides expenditure data within your own fiscal year. Oftentimes within myself or my team, we would run risk assessments to help inform monitoring actions and identify program risk by comparing the CFA data to other available reporting information and other public disclosures. When we found inconsistencies, we would often start by just sending an email or having a conversation with the grantees. And in several instances, this resulted in opening a monitoring, right? So each of these cases, the grantees expressed surprise because they did not have findings or the auditors did not find adverse issues, when doing the single audit, and they might have had years of clean audits. But there potentially was not a tuned eye to ensuring that there's consistency in reporting across funder reports. Some of the other reasons where single audits might have fallen short in identifying areas of compliance risk were either because the the auditor who is doing the review identified major programs, but they didn't identify a program that was really complicated, either because that organization does not receive a lot of funding under that program, or because they get, a lot of funding from other programs and they're big, and those are the ones that Subpart F directs the auditor to review. I think a good example of this might be a protection advocacy system under ACL that receives money through a DD Council. DD Act and DD Council fiscal requirements, particularly statutory requirements, are really complex. And when that money's passed down, it has a multi-tiered match requirement that I think a lot of P&As struggle with because they don't have access to outside funds. An auditor is not likely to look at that source of funds because it's going to be smaller than a P&A's prime awards. But as far as level of complexity relative to the amount of funding, it's a really high risk zone. Part of the reason I bring up this topic is one, because I've opened compliance and made findings against entities that have a consistent track record of clean single audits, but also to inform grantees to be more proactive with their auditors in scoping out areas of need or what they define as risk so that you're more collaborative and that you are getting the best bang for your buck. right? And the last topic I would bring up relative to this issue is if your major programs do not have a compliance supplement. And specifically, our compliance supplements are documents developed by the federal funder, right, by the federal agency, and they're put into OMB's compliance supplement. And they're a resource that the auditor uses to direct its programmatic or major program review when they're doing a single audit. If those compliance supplements are non-existent for complicated programs and/or the compliance supplements are outdated or not really well laid out, then it's going to result in the auditor doing a less robust review. And specifically in the cases when a compliance supplement doesn't exist, the auditor is going to have to default to the default compliance supplement in OMB, which isn't going to give them insight on program specific details and really help guide them on the likely compliance challenges that you all are facing. So one thing to take note of, and I, mentioned this before, is again to be really proactive in the scoping of your single audit process and to seek out, collaborative relationship with your auditors, and talk about risk areas and places where you would like them to focus on, mainly so you can grow as an organization and be knowledgeable of your potential compliance risk. Probably the worst case scenario is that your single audit from year to year to year looks the same and you feel like you're just on autopilot, right? As you're going through the process, that the auditor is not really growing with you and challenging you to grow as an organization. I don't want you all to have findings, right? I'm not wishing findings upon you, but I'm looking for you all to get a strong cost benefit analysis from these required audits and to help get good guidance for process improvement and growth as an organization. Also, if you have clean single audits and a federal reviewer comes out and makes strong substantiated findings, it's really frustrating that you paid so much for a single audit and they missed pretty basic findings in a lot of instances. So travel, right? For those of you that do travel, at times this could be your most robust process or policy because there's lots of different ways to travel and in-state and out-of-state requirements. Plus, your employees have to be actively engaged in this process and to be really astute and transparent to put you in the best position as far as doing accurate and reasonable reimbursements, right? Our first common scenario comes back to the first topic we talked about, which is outdated policies and procedures, right? You need to stay up in alignment with any statutory or regulatory changes, including 2 CFR 200, and you need to be adaptable to any other federal rules or requirements or state laws that apply, right? For instance, staying in line with the IRS's mileage rate. As far as actually having findings and resulting in an allowable cost, most commonly happens when travel forms are either inaccurately produced, the information is not substantiated against a correct source, they fail to enter required, travel expenses or projected expenses, and specifically the employee doesn't sign the travel form or the manager does not sign the travel form and money's paid or reimbursements issued without required management approval. The without required approval often shows up in my experience with executive leadership because there haven't been strong checks and balances put in place to ensure that a CEO or COO or an executive director has their travel reviewed by a board member or an oversight entity when applicable. Policies and procedures and rules might allow a certain level of discretion for ease on the executive director, but ultimately bigger trips likely have to be reviewed by someone. So who is their check and balance? How do you define this in policy, and are you implementing it in practice? When it comes to things like hotel and per diem rate, most commonly federal grantees rely on the GSA standards. And guess what? You actually have to check these when you're traveling to certain areas and ensure that you make updates for first and last day, for half days, for provided meals. These are really important. And if you miss out on some of these key aspects, potential unallowable costs can add up because they're there for each participant that you overcharge travel days or didn't account for lunches provided at conferences. Because you'd take a $35 charge that's overdone and then multiply it by four participants or five participants or so on, or across the year of inconsistent implementation. Probably the last and, I would say thing that does not stick out as much, but is particularly common in formula award area. And formula awards in federal space are also called mandatory awards. So these are awards by statute that you qualify for a formula and receive allocations every year. Um, a lot of times, one's expiring and one's coming available, or maybe you have concurrent awards. You need to pay attention to the period of performance. This is the time in which you have to obligate costs, to incur allowable expenses, and to implement the award activities. I have made findings against entities, and this was just pure accident, where they reserved and paid for travel with an award that was expiring at the end of the federal fiscal year, September 30th, for a training that was taking place in the next federal fiscal year. In their mind, it made sense because they needed to pay ahead of time and get everything locked in to ensure that their staff had access to the training and didn't miss out. But they paid for something, paid for an expense that wouldn't be realized within the period of performance. So the activity was not completed, and that becomes an unallowable cost, right? Um, these things are important because they're simple mistakes that could result in findings or unallowable cost, and they could be, compounded by just, simple administrative errors that get translated across multiple programs because the core policy and procedure or core SOP is not applying the correct standard. Um, When I used to do single audit resolution, particularly at ACL, we were responsible for single audit resolution, and this could have been state pass-through entities when they were having a state audit done relative to single audit standards, or for nonprofits who were submitting a single audit. I commonly see findings around delinquent submissions, right? And this could be delinquent submissions of your program performance report or your federal financial report, or it could have been a delinquent submission of your single audit to the Federal Audit Clearinghouse, right? When I work with grantees specifically on process improvement, I talk about the importance of making program overview worksheets to identify key statutory requirements, key deliverables, and systems that are going to ensure that you stay on time and meet all expectations. And I also talk about the importance of making fiscal year calendars that outline key deliverable dates, key submission dates, and key deadlines so that there's accountability and transparency across the organization. Because ultimately, it's faults and not understanding specific award requirements or grant terms and conditions are the common scenarios that lead to findings under this category, right? Specifically, some issues that, lead to this finding and that could come up commonly in your organization include, relying on an outside entity, particularly relying on an outside accountant to run your books and to produce the data that you'll need for a financial report. You could have also had a staff changeover, and that resulted in nobody having access to a core system. And this is an internal control and check and balance that you should have in place within your policies and procedures. So there's a contingency plan to ensure that users are, there's always a user in the system under the current, staffing model, right? It's also a reminder to have backup users and key systems for your funders to ensure that you never lose access to the system. For those of you who make direct draws or financial reporting in HHS's payment management system or PMS, you all know how long it takes to get into that system right now. It could be months because all of the new credentialing requirements and submission requirements. So I'm going to turn from the direct grantee to the pass-through, right? And again, from a single audit perspective and from a federal monitoring perspective, a common finding for federal pass-through entities, particularly at the state level, is that they're not actually honoring their monitoring and oversight responsibilities in 2 CFR 200-332. Right. And sometimes this can be unintentional because of staffing shortages, or maybe they have too many programs and, it's impossible to get to all of them. But it could also be because they really haven't sat down and updated their policy and process. They haven't looked at their portfolio and laid out a risk assessment to see what programs are the most risky and what are the factors that are producing the risk. They also potentially have not updated monitoring protocols, and particularly transition to monitoring protocols that are more digital in nature. This can include getting documents digitally, doing the reviews virtually, or having a variety of different monitoring modalities that are reactive to risk. When I was at ACL and designing out new monitoring protocols, there was seven different modalities that we had available for us based on the level of risk, the available staff, and the needed density of the review. And density meaning scope and level of effort, where it could be very targeted to a narrow part of grantees' operations. It could just focus on fiscal and administrative. It could be comprehensive. It could be an on-site visit, or it could be a program level issue. And I ran 2 network level monitoring efforts when I was at ACL, one to tackle grantee understanding and compliance with the match requirement under the DD Act for DD councils, and one to understand P&A grant compliance and understanding with the extended program income requirement outlined in the DD Act, right? These had a totally different scope, particularly a TA scope, with the goal of identifying where challenges are and increasing knowledge and understanding to encourage better statutory compliance for years to come, right? Because good stewardship and good information from the federal level positions the grantees to be successful and to honor the expectations of the appropriation, right? Why the program exists. So having a monitoring protocol or monitoring approach that allows you to be more adaptive and more flexible in how you implement your oversight responsibilities and react to understood risk puts you in a position to approach monitoring from in a stronger way and be more comprehensive. Lastly, we couldn't have a list of common mistakes that lead to findings without talking about indirect costs. I should have thrown procurement on here, but I chose indirect cost instead, particularly because of I think the misguided use of the term de minimis and your ability to take the de minimis. And particularly during my time at ACL, I did follow up with a lot of organizations when they fail to include data on indirect cost in box 11 of their federal financial report. And I often found out that a lot of entities that were using the de minimis didn't really understand what it meant. And specifically, did not understand the internal controls and accounting system, operations, and layout that needed to be in place in order to charge indirect costs. Really, you need to have all the same tools in place to charge the de minimis that you do need to have in place if you have a negotiated rate. You need to understand cost allocation. You need to be able to classify cost as direct or indirect. You need to have an accounting system set up that allows for cost allocation and charging indirect cost. You need to have internal controls and checks and balances to ensure consistency, and you need to be able to appropriately apply indirect cost across all programs, especially accounting for any statutory requirements that might limit your ability to charge admin or indirect cost. And you need to be reactive to changes in 2 CFR 200, including the increase to 15% de minimis indirect cost rate. Specifically, you have to be knowledgeable of the direct cost base, and knowing that de minimis requires you to use the modified total direct cost, the definitions in 2 CFR 200 subpart A, while with the negotiated rate, you're beholden to the base as it's defined in your negotiated agreement. You have flexibility on choosing the appropriate base when you submit the proposal to get the negotiated agreement, but once that negotiated agreement's in place and your rate set, you have to align your systems and your operations to ensure appropriate calculation of the base and application of the indirect cost rate to the base. I saw many grantees who were applying the indirect cost rate to the federal award amount, and this is totally wrong. Your federal award, right? If you're doing box 11 and doing the 425 and you say your base is the federal award, you're telling the federal agency that all of your federal award costs are direct costs. Therefore, you have no indirect cost. So indirect cost is always applied to the direct cost base. And under the de minimis, this is specifically defined as the modified total direct cost. If you fail to do indirect cost properly, if you don't have the controls or processes in place, you will incur unallowable cost. I specifically worked with a grantee at ACL that applied the wrong indirect cost methodology for several years on end, and we're stuck with an over $200,000 bill because of over reimbursement of indirect cost. I don't like to spend a whole lot of time dwelling on unallowable cost, but that is the most compelling and scary result of having federal findings. Because nobody wants to pay money back, and nobody wants to have a threat of having their award terminated. All right. So there's a lot of things that you can actively do, and Team DWC would love to partner with you if you're worried about potential compliance issues, or you think there's opportunities for process improvement, or you want to explore stacking and understanding how your program statutes align with the Uniform Guidance Regulations and what pivots you might have to make inside of your SOPs or systems or operations to ensure specific compliance within a given program. Right now, I'm working on 6 active contracts with a variety of different approaches, but a lot of them are focused on process improvement or better understanding of statutory requirements, or ensuring, in the case of federal pass-through entities, that the funds that entities receive through the pass-through process are appropriately classified, that have transparency and disclosure about the requirements, and that the entities are put in a position where they clearly understand their compliance. I call it compliance umbrella or compliance box, so they can successfully implement the programs. Because there's nothing like having finding or the risk of mistakes when you don't understand the requirements or don't have transparency on the requirements. We also do customized training and technical assistance, particularly love to work on statewide or network-wide approaches. And if you just need a little bit of support here or there, then we're happy to provide some hourly support or jump in as a partner to help you solve a challenge. I did want to let you all know we did put a new slate of Insight Grants webinars up on the website. So we have sessions planned for July, August, and September to keep up with our once a month cadence. Next month, we're going to be talking about end of federal fiscal year topics, including closeout, carryover, and spending down grants. We're going to touch in on program income. And to start the fall, we will jump right into indirect costs, cost allocation, and all things cost classification. I will see if we have any questions and you can put them in on the chat, or I can take people off mute if you raise your hands. And if you do have something you want to explore afterwards, I'll put my email in the chat and you're welcome to follow up with me directly. We can do, a phone conversation, a webinar, or just reach out over email as well. But we also love to answer questions here in the presentation if you all want to step forward. So we do have a blog post about the proposed um, changes to the uniform guidance, and I'm going to link that real quick in the chat. I think Dave does a pretty good job of breaking down some of the things that stick out in the uniform guidance and to be mindful of, but just realize that they are proposed changes. So we don't know if they'll actually be implemented or if they will, be modified and, change as um, public comment comes in and they further look at the specific issues. So I think one of the big takeaways in there is the increased focus on subrecipient monitoring and adding more depth there because that's an area where the federal government is looking to transfer risk. And a lot of these components about transferring of risk, and it's not just to the pass-through entity that's doing the subrecipient review, it's by the pass-through entity to the subrecipients that are receiving the funds. So understanding the risks that are falling onto you and the role of where you are in that web of funding is really important. And then someone asked about the timeline if the changes are implemented. With the changes that happened recently with uniform guidance, it was a phased implementation. So I don't have a good answer on that one. It will either, be the start of FY27, which seems incredibly too quick. So more likely FY 2028 as a full implementation. Specifically, I would keep an eye on the OMB guidance, but you're really not going to get them locked down until you get an amended contract from your funder saying these are the specific terms and conditions, and this is when they go effective, and this is how we are going to apply them or not apply them to existing funding. So really look to your funder or if to your pass-through entity if you receive pass-through funding. Those are some really good questions. And unfortunately, we have a lot more of proposed changes to react under the current administration. So it just stay mindful and be in preparation mode. And it's a good reminder to do some internal assessment and internal review to see if the areas being identified are ones in which you have opportunities for process improvement. Right. And Linda, I see your hand up, so I will, um, let me see if I can get you unmuted. Let's see.
Looks like I'm unmuted.
Oh, great. All right.
I just have a quick question on the travel and the GSA
Mhm.
rates. So the US Aging Conference this year is in July in San Diego, and
Yes.
GSA rate is 237
Yes.
before taxes, and the room block for US Aging is 285. So,
That is fine, right? So if you have a contingency within your travel policies that say you are meeting at a space that's more than the GSA rate because of the conference setup or the desire for synergy or all of that, then that's fine.
okay, does that needs to be in our policy though, or not? I mean, because
I
gen
would
what?
recommend, just from an efficiency standpoint, having those deviations, why you would deviate from GSA in there, or just a statement that says, we'll make appropriate deviations based on programmatic need or something like that.
Okay,
And that the it gives you the ability to make a pivot as needed. But I will tell you, as a federal monitor, if I saw that and your justification was to be at the site,
right.
then that's fine,
Yeah,
right?
because it would cost more because then you'd have to Uber to the conference and all of that. So,
Correct. And you miss out on the opportunity to have the relationships and connections with
right,
others in the network, right? That you wouldn't have if you were at a facility a couple blocks away,
right.
right?
Yeah,
And you might
that's
skip sessions, all of those types of things, right? They're
right. Yeah,
distractions that,
right. Yeah, I wasn't implying that anybody needed to change their reservation, but just wanted to make
yeah,
sure if that needed to be in our policy that if we deviate from that GSA rate, and here in Minnesota, we have to follow the meal reimbursements that's in the commissioner's plan, which is
yes.
well below the GSA rate. So,
I've seen some of those much lower,
yeah.
right? Um, So yes, this is the stacking piece, right? So knowing the requirements that are at play and then having things as an internal control within your policies and procedures that are reactive to any deviations, right?
Okay.
And it could be a one sentence contingency, right? Or it could be a list of the common reasons we might deviate from this standard would include da 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 da. Management will review this and approve appropriately to ensure that the deviation has appropriate oversight.
Okay. Thank you.
Yeah. Yep. Well, thanks for hopping on. That was really nice to get verbal feedback. Um, I don't see any more questions in the chat. Uh,
This is Lori. I'm sorry. I
yeah.
don't see the hand button on the screen
Oh,
here.
that's okay. Yeah.
So with the stacking, if the federal funds are coming through to a state entity as the pass through, then when they pass that on down to another entity, such as a nonprofit or whatever, do they need to indicate what their separate out what if they have requirements that are in addition or over top of what the federal grant requirements are? Do they uh, should or is that not just it just doesn't seem very transparent to know
So
what is a
yes, they need
federal
to be
requirement
transparent.
versus state?
Yeah, they need to be transparent and they need to separate that. So 332, right? 2 CFR 200 332 lays out specific requirements that must be included within a subrecipient agreement to ensure that there's transparency about the federal funds, specific federal funds and programs, right, that are providing funding to the subrecipient. But then they also need to identify state law and requirements, right, that are on top of that.
Okay.
One that provides transparency so everyone can be successful, right? And two, it also allows an opportunity for conversation if the state law might actually not be, applicable or a reasonable standard, right? Because it could counter a statutory requirement. And in that case, the pass-through entity would need to allow the statutory requirement to override. Um, but general lack of transparency is usually a result of state governments wanting to have a fixed set of processes for contracting or subrecipient agreements, so they can work like a machine as opposed to being reactive to what the programs actually need, right? And what's expected of the state as a pass-through entity going beyond the baseline requirements in the uniform guidance. And I'm not implying that this is easy to hold a state government accountable, but the reason to push back and to request more, get more from the state is because when they're not transparent or do not provide clarity on needed requirements or oversight expectations, then it increases the risk on you as the subrecipient and to anyone else that you're passing the funding on to. It also creates a liability for the state because if there is misuse funds, then the federal government's going to come back after them first because they're the prime and the primary entity responsible for stewardship and appropriate use of the funds. I will say in 3 of the 6 contracts I'm working on right now, I think one of the core issues is tackling the topic you brought up. Yeah. I really appreciate the questions and feedback today. And thank you all for making time for Team WC and for participating in Insight Grants. Hope to see you at future Insight Grant webinars. And I hope you all have a wonderful afternoon. Those of you that are at end of school year for children or grandchildren, hope everyone has a wonderful transition into summer. All right. Thank you so much.